Every year, thousands of new crypto investors wake up to zero balances. Hacks drain their accounts, exchanges go bankrupt overnight. The money is just gone. But it is rarely a flaw in the code that wipes people out. The losses come from user error. People fail to handle the basic physical requirements of storing their own digital assets. When you move your money from a traditional bank to a decentralized network, you are making a massive trade. You are giving up the financial safety nets built over the last century. This chart maps out exactly what that trade looks like. The vertical axis represents control. At the bottom, institutions dictate how and when you can move your money. At the top, you have complete financial autonomy. You answer to no one. The horizontal axis represents personal liability. On the left, if you forget a password, you click a reset link. On the right, if you lose your keys, your money is gone permanently. Traditional finance sits safely in the bottom left. Crypto operates entirely in the top right. To capture the outsized returns possible in that top right quadrant, you have to drop the idea of easy money. You have to accept total, unforgiving responsibility for your assets. The fastest way to fail that responsibility is by taking your entire bankroll and throwing it into a single trending altcoin because an influencer said the price was going up. The math on these assets is brutal. During a bear market, the vast majority of altcoins drop 80 to 90%. Many of them never recover. When you hold a single asset, a 90% drop obliterates your portfolio. One bad week can wipe you out completely. The defense against this is mechanical structure. You dictate exactly how your capital is divided before you execute a single trade. This chart illustrates a baseline stability model. It operates on a strict 50-30-20 split. You allocate 50% to Bitcoin for foundational stability. You put 30% into Ethereum. And you strictly cap your highly speculative altcoins at 20%. This allocation sacrifices the dream of multiplying your net worth 100 times over in a week, but it ensures that no single hack, bad tweet, or project failure can take you to zero. Once you buy your assets, the next trap is convenience. You leave your funds sitting on Coinbase or Binance because the interface feels exactly like a checking account. Legally, the crypto sitting on an exchange is not in your wallet. It resides in the exchange's wallet. You hold an IOU, not the digital asset itself. If that exchange files for bankruptcy, which we saw happen with FTX in 2022, you are instantly reclassified as an unsecured creditor. You go to the back of the line and you lose your investment. True ownership requires removing the middleman. You have to move your funds offline onto a physical hardware wallet. This table compares exactly what you trade when you move from an exchange to a hardware wallet. On the centralized exchange, your upfront cost is zero and the convenience is incredibly high. But your catastrophe risk is maxed out. A hardware wallet costs about $70 and creates immense user friction, but it grants you absolute sovereign ownership of your money. That sovereignty operates on strict physical rules. You generate a master seed phrase. You write those 12 or 24 words down with a pen on paper. You never take a photo, and you never store it in the cloud. If you lose that piece of paper, there is no customer support desk to call. Your money is permanently destroyed. Then comes the psychological test. You open social media and see influencers shouting about a new token right as its price rockets upward. This graph illustrates the timeline of a standard crypto hype cycle, and it shows exactly how retail investors get manipulated. It starts here in the accumulation phase. Early investors and insiders buy quietly while the price and trading volume are flat. By the time the asset is trending on YouTube, the price has already exploded. This peak is where retail investors buy in, driven by the fear of missing out. Right as the crowd buys, those early investors sell off their holdings. The price collapses, and beginners are left holding assets at a massive loss. You survive this cycle by demanding technical literacy. Before you buy, check if the code has been audited. Review the tokenomics. If you cannot verify the utility, you do not buy. Even with solid assets, you have to survive your own instincts. In this market, standard corrections routinely drop prices by 30 to 40%. If you check the charts daily without a predefined strategy, you will panic. You will sell your holdings at the bottom, locking in your losses right before the market recovers. Emotion is the enemy of profit. You must define your exact entry and exit points before you invest, and let the math dictate your actions when the market drops. The crypto market operates as a strict transactional system, exchanging institutional safety for personal autonomy. The moment you make that trade, your protections vanish. This flowchart strips away the noise to map your risk profile against operational realities. Question 1. Are you willing to secure a physical seed phrase offline, accepting zero customer support if you fail? If the answer is no, your priority is convenience. Avoid self-custody entirely and stick to traditional vehicles like Bitcoin ETFs. If you answer yes, you face question 2. Can you hold through a 40% drop without panic selling? If you can, you move forward by enforcing strict rules. Maintain the 50-30-20 portfolio split. Secure your assets on a hardware wallet. Demand technical utility over social media hype. Interacting with decentralized platforms while ignoring security protocols guarantees capital loss. Write down your exact rules of engagement before you put a single dollar on the line. Because in a decentralized ecosystem without safety nets, rigorous operational discipline is the only thing protecting your wealth.